Hello. Now we are going to do receivables management. Now, as you all know, receivables occur in a business because we sell our goods on credit. Okay, they are the results of credit sales, and receivables essentially means your debtors or your customers. So when you sell goods on credit, you will have receivables. Now it looks so easy, but then there are many things that you have to decide. Okay, for example, let us say what will be your credit policy. Okay, that is, what are the terms and conditions, what are the standards that you will look at when you give goods on credit to your customers. Okay? There are credit terms, like say, what will be the cash discount, will there be a cash discount or not, what will be the collection policy, what will be the credit period, that is, for how long will you give credit, because as business we want our money to come back early to us, right? And the longer the credit period, more will be the amount of more will be the time for which your funds are blocked into debtors. And when your funds get blocked somewhere else, it also entail what we call it as opportunity cost, right? So there are various things like, to whom will you give credit, what will you look in a customer to assess whether a customer is credit worthy or not. All these decisions are part of receivables management. Okay, as far as credit policy is concerned, it can be largely strict or it can be liberal, right? When you become very strict, what will happen, your average collection period, that is a time taken on an average by debtors to pay you back, will come down. What will happen more, if you become more strict, your bad debt will increase, but maybe your collection expense will also increase. Similar is the case with liberal credit policy, that is, you are not concerned or bothered about what time debtor will take to pay you back. Your collection period on an average might increase. So if your collection period increases, it means funds are getting blocked for more number of days. It means your opportunity cost will be higher. Okay. Now you are being liberal, you are not so strict in collecting. Your bad debt may also increase. Okay. Sorry. Here, I'm sorry. When you become strict, your bad debt comes down. When you become liberal, your bad debt increases. Okay, and you are not putting much efforts in collection, so your collection expenses are also going down. Okay, so all these things might happen. Now, whether to be strict or to be liberal, okay, it depends on cost and benefit. Okay, so essentially what we are going to do here is, we are going to see what all are benefits of each policy, what all are cost associated with each policy, and what is the net benefit of each policy, whether we should become strict, or we should become liberal, or we should do nothing. Okay, so let us see it through examples. What are the different types of credit policy, or how do you take decisions about credit policy? Okay, let us see example number 1 from our remedial session. Okay, see what all is given to you. A firm is currently selling a product at rupees 10 per unit. So you are given selling price is equal to rupees 10 per unit. The most recent annual sales were 30,000 units. variable cost is rupees 6 per unit, variable cost is 6 per unit, and average cost for a volume of 30,000 units is given rupees 8 per unit, right? You are given fixed cost here 30,000, sorry, fixed cost is 60,000. The average collection period may be assumed to be 30 days. The firm is contemplating relaxation of credit standards that is expected to result in 15% increase in unit sale, and the average collection period will increase to 45 days with no change in bad debt expenses. Now what they are thinking, what this business is thinking, that you want to relax credit standards, that is, you want to become more liberal. As when a business becomes more liberal in its credit policy, generally what happens is that the sales increases. Okay, so let us just make the table for solution and we will analyze this. Okay, so there is a present policy and there is a proposed policy, right? Let us see sales in units. So you are already told that currently the firm sells 30,000 units. If the firm sells, if the firm uh, 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 relaxes its credit standards, sales will increase by 15%. So the new sales will be 34,500, right? Selling price is given to you, variable cost is given to you, fixed cost is given to you. Average collection period currently is 30 days, which you are told that will increase to 45 days here. Okay. Okay. Now they are also saying it is expected that increased sales will result in additional working capital to the extent of 10,000. Okay. If you additional working capital 10,000, if you go for the proposed policy, and you are also given ROR on investment is 15%. Last thing they have asked is, should firm relax its credit standards? Okay. Let us do a cost benefit analysis. Let us start with sales. So sales at the rate rupees 10 per unit, you are given selling price 10. So 30,000 into 10, currently sales is 3 lakh. If the firm relaxes its credit standard, the sales will be 34,500 into 10, 3,45,000. Minus variable cost. Variable cost is rupees 6 per unit. So 6 into 30,000, 1,80,000, and 6 into 34,500 is 2,07,000 rupees. Minus fixed cost. In this question, fixed cost is given to you. It is 60,000. Now, as you know, this cost is fixed. So you do not need to find fixed cost. You just have to state that even if the sales increases or even in the new plan, the fixed cost will be same, that is 60,000, right? Let us subtract all of this and find an answer. 3 lakh minus 1,80,000 minus 60,000. Here's the surplus, or this is basically EBIT, right? 60,000, 3,45,000 minus 2,07,000 minus 60,000. Here the profit is 78,000, right? Now what you have to do is you have to see what are the additional expenses because of this policy, right? So here there are no explicit cost. Okay, there are some costs that are explicit. For example, bad debt is an explicit cost. collection expense is an explicit cost. Okay, that is they actually have an impact on your cash flows. But then there are some costs that are implicit cost. For example, say opportunity cost. Now, what is the difference between accounting and finance? In accounting, we don't consider opportunity cost. We only take into consideration only all the explicit cost. Here, this is finance. The roots of finance are in economics, and in economics, we consider opportunity cost to find out whether our decision is correct or not. Okay. So what we will do here is, from this profit, we will subtract investment in debtors, that is nothing but opportunity cost. Okay. And how do you find out opportunity cost? So first of all, see what is your investment that you have done. See, in the present policy, you are doing a sales of 3 lakh, but your investment in present policy is 1,80,000 in variable cost plus 60,000. That is the amount you have spent, right? So in the present policy, your investment or your expense that you have incurred is 2,40,000, right? It takes around 30 days for this money to come back. It means your funds get blocked for 30 days. Okay. So this 2,40,000 is for whole year. What will be for 30 days? So into 30 by 360. Let us take 360 days in a year. Okay. Multiplied by. So 2,40,000 into 30 by 360, you will get the amount invested for 30 days. Now, had you invested this fund somewhere else, you would have got a return of 15% because your ROR on investment is 15%. Okay. So multiplied by 15%. 2,40,000 into 30 by 360 into 15%. Your opportunity cost of investment in debtors or giving goods on credit is 3,000 here. In proposed policy, again let us do, what is your investment? So you have invested 2,07,000 in variable cost, 60,000 in fixed cost. So your investment is 2,47,000. This will get invested for 45 days. So 45 by 360, you will get the amount invested for 45 days. Had you invested this somewhere else, you would have got a return of 15%, which you are losing out by giving goods on credit. Okay, so that is why it is your opportunity cost. So 2,47,000 into 45 by 360 into 15%, 4,631.25. That is your opportunity cost is increasing when you loosen up your credit standard. That is, you become more liberal, your collection period increases and opportunity cost increases. Now you are also told that additional working capital required here is 10,000. So additional working capital 10,000. Now we don't take investment here, okay? But had this 10,000, had you invested this 10,000 somewhere else, you would have got a return of 15%. So investing additionally in working capital also has opportunity cost. Okay, so I am writing opportunity cost of working capital. So you are investing 10,000 in working capital and opportunity cost is 15%. That is return you could have earned if you had invested somewhere else. So 1,500 is the cost of investment in working capital. Now let us see what is the net result. So here it is 57,000. You can call this as profit. You can call this as surplus. Whatever by name you want to call. 78,4631.25 and 1,500. So 71,825 68.75. So this is a total profit method where you see the total profit in present and proposed. So you can compare both and you can see that profit in proposed plan is more. Okay, by how much? So let me find out. Incremental profit. Incremental profit means your profit is increasing from 57,000 to 71,868. It means your profit is increasing by 14,868.75. This is your additional profit if you select the new proposed policy. So as you all know, you have to write the interpretation. So the company should relax its credit standards, go for the new policy, right? Because obviously it is giving more